Money Talks. I'm Greg Vogel, Portfolio Manager at GKV Capital Management. For the first time in a long time, investors are able to earn a decent return on fixed income securities. Higher interest rates have an obvious negative impact on borrowers. With higher rates, loans are more expensive. This slows both consumer demand and business investment. For example, average 30-year mortgage rates are at 7.25%, up from 2.75% back in August of 2021. It's only 2 years ago. The average car loan APR is now 8.88%, although rates vary widely depending on whether the car is new or used and your credit score. But with the highest median home and auto prices, few can afford financing costs that have nearly tripled. But if you don't need a loan, if you're saving money, higher interest rates can generate a predictable return while reducing the volatility of a portfolio. This chart gives you an idea of just how fast interest rates have risen. Here are the U.S. Treasury yields for both the 2- and 10-year maturities over the last 20 years. As the economy emerged from the pandemic, the combination of pent-up demand, massive government stimulus, and supply chain disruptions, coupled with cheap loans, altered the balance between supply and demand, driving inflation to the highest level in 25 years. To rein in inflation, the U.S. Federal Reserve has had to aggressively raise interest rates, slowing economic growth. Fixed income securities, namely bonds, have always had an important role in investment portfolios. Although bonds are simple securities compared to equities, they don't get nearly the attention of stocks. They're less accessible and generally poorly understood by most individual investors. Diversification of a portfolio is important. Ideally, you want to invest in several different uncorrelated asset classes. Uncorrelated means that the performance of the assets won't always move in tandem. Diversification doesn't do you a lot of good if all your investments lose significant value, in the case of a recession, for example. We generally organize investment asset classes into 5 categories: equities, alternatives, fixed income, real estate, and cash. On a spectrum, equities are the most volatile, rising and falling significantly year to year. Alternative assets, such as commodities, currencies, collectibles, and derivatives, run a broad spectrum of likely risk and returns depending on the details of the investment. Real estate is generally more stable than stocks, but have a lower return, while fixed income or bonds are even less volatile. Lastly, one can sit in cash, which has the least volatility, but usually a negative return after accounting for inflation. Here's a chart showing the performance of stocks in the S&P 500 versus the aggregate bond index over the last 25 years. Stocks gained 213%, while the value of the bond index gained 60%. While the return on stocks over the long term is clearly superior, you can see the volatility. There's big gains and losses from year to year. I want to talk in a little more detail about fixed income securities. Bonds seem to be poorly understood. Very simply, a bond's a loan. When a company or government issues a new bond, it's borrowing capital from investors. You can buy today a 2-year Treasury bond backed by the U.S. government at a 5% interest rate. The U.S. government will pay the bondholder interest twice a year, and at the end of the 2 years will return their principal. This is an important difference between stocks and bonds. A bond issuer has a legal contractual obligation to repay the face value of the bond at maturity, assuming that the issuer doesn't go bankrupt. There's no such guarantee for owning a stock, or even a bond fund for that matter, but I'll return to that in a moment. That's not to say bonds can't go down in value between purchase and maturity. If I bought a 10-year bond back in 2021, my coupon rate, the interest payment I would receive for the next 10 years, would have been an annual return of only 1.25%. That was the going rate at the time. Remember the chart plotting the yield of the 2- and 10-year Treasury bond I showed you earlier. Now that rates have moved up, a 10-year Treasury is paying 4.2%. That bond you bought 2 years ago with a 1.25% coupon is not so attractive to a new buyer. You don't have to hold the bond until it matures. You can sell it at any time. The bond market is very liquid. But if the coupon on the bond is considerably lower than the current yield for new bonds, well, you're going to have to sell that bond at a discount. You're going to take a loss. The buyer of your bond will want the equivalent of a 4.2% coupon, which means the offer on your bond back at the low yield 2 years ago is worth 80 cents on the dollar, or a 20% loss from par value. Importantly, with bonds, you don't have to take that loss. You can hold on to the bond until it matures. You will collect your meager 1.25% annual coupon payment each year, and at maturity, you will receive the full face value. If you hold the bond to maturity, you won't lose money. Of course, you do have an opportunity cost. You will be earning only 1.25% over the remaining 8 years, while new bond investors are being paid 4.2%. Where bonds become particularly attractive is when interest rates have peaked and may decline. Locking in that 4.2% coupon for 10 years will be very attractive if interest rates go down. Over the last several years, due to the ultra-low interest rate environment, we reduced bond holdings for our clients. Now that interest rates are higher, we have been increasing our allocation to bonds. Do note that investing in a bond fund is not the same as owning an individual bond. In the case of a bond fund, there is no guarantee of the return of principal. A fixed income fund is continuously buying new bonds to replace ones that mature. The value of the bond fund will move up or down based on the interest rate movements and the perceived risk of default. Rising interest rates will push the current mark-to-market value of the fund lower. Conversely, if interest rates decline, the value of the fund will increase since the bonds in the fund pay more than the new issue bonds at the lower coupon. 2022 was a disaster for the bond market. Due to the rapid increase in interest rates, the U.S. aggregate bond index declined 13%, which is the worst year for bonds since the 19th century. So here we have 3 portfolios with various asset class compositions to highlight the impact of fixed income securities on a portfolio. The first portfolio is all equities. Wall Street considers this an aggressive portfolio. The near-term price swings will be big, although over time stocks have appreciated nicely in value. The volatility, as measured by the standard deviation, is also significant. For example, the 10-year performance of the all-equity portfolio gained 12% annually, but during that period the performance swings were greater or less 15% of the annual return, 2/3 of the time, which is one standard deviation. By comparison, in the moderate portfolio consisting of 30% bonds, 60% stock, and 10% cash, the return was lower at 7.8%, but the volatility was 1/3 less with a standard deviation of 10. The addition of bonds will lower the returns, but will also reduce the volatility, reducing the risk. This is why it's suggested that as investors age, portfolios should be adjusted to reduce risk by increasing exposure to fixed income. Having a shorter time horizon, older investors will have less time to recoup losses in the event of a major stock market downturn. So there's nothing special about the 30%, 60%, 10% asset mix in my moderate scenario here. The portfolio can be tailored with any mix of asset classes to best meet your individual goals and risk profile. The point is, a mix of fixed income assets can be used to reduce volatility and still generate solid returns, particularly now that rates are near 25-year highs. So I spent much of my career as a technology analyst evaluating software stocks. I have a bias towards equities in general and growth companies in particular. Over the long term, growth stocks will outperform, but the volatility will be significant. It's important to have a diversified portfolio. That includes uncorrelated assets such as bonds and certain alternative investment vehicles. They don't need to be a large part of the portfolio, but they can reduce volatility and some of the short-term risk. We think interest rates are close to a near-term peak. If that's correct, short-duration bonds paying more than 5% are attractive. If the economy weakens into a recession, the Federal Reserve will have to cut interest rates, giving bonds a boost, while the value of stocks will decline. If the economy remains resilient and inflation continues to moderate towards 3% or the Fed's target of 2%, then a 5 or 6% yield to maturity for fixed income assets with lower risk is very attractive. If inflation is under control and economic growth accelerates into 2024, stocks will outperform bonds. But having some portion of your portfolio in fixed income won't hold the performance back too much and will provide some insurance if the stock market weakens. There is no perfect model portfolio. Ideally, your portfolio should continually be tailored to meet your specific needs and adjusted to take into account the current economic environment. This is something we're doing for our clients on a continual basis. For more detail on our analysis, you can download our quarterly update from our website at gkvcapital.com. You can also sign up for our email distribution list to receive our reports directly to your inbox. Thank you very much for watching.